Good afternoon and welcome to the Family Office webinar. Thank you for joining us today. My name is Naji Nami, CIO of Petrol Asset Management, and I will be your host today. I'm very excited to host this webinar with Johannes Hughes, partner and head of KKR operations in Europe, the Middle East, and Africa. Prior to joining KKR, Johannes was a member of Investcorp Management Committee and was responsible for the firm's operations in Europe. And he worked also at Salomon Brothers, where he was a VP in the M&A department. Johannes holds a Bachelor of Science with the highest honor from the London School of Economics, an MBA from the University of Chicago. Johannes had an incredible journey at KKR. He joined the group in 1999 to the establishment of the European office. The group back then was 30 people and $21 billion under management. Today, fast forward, Johannes is partner, head of EMEA. The group has close to 1,500 employees across the world and more than 200 billion in assets under management. He's a serial entrepreneur investor in Europe, and we are glad to be partnering with him on several successful transactions in the past, Alliance Boots, and more recently, LGC. Johannes, many thanks for joining us today from Paris. I understand you prepared a few slides for us on the PE landscape. I suggest we take 20-25 minutes just to take us through the insights of how you're seeing European private equity today, how you and your team are navigating the environment. And then for sure, we want to open it up for questions from the audience so they have a chance to engage with you in topics that they have in mind for private equity in general and Europe in particular. Thank you, Johannes. Good to have you.
Thank you very much, Naji. Thanks for this very fulsome introduction, and I really appreciate it. So first of all, I hope that everybody on this call is healthy and safe in these really unsettled times. I want to start always with that, and I wish you continued health and safety as we battle the COVID crisis globally. So the idea for this was to sort of give you a little bit of an insight as to what we at KKR have done in response to the crisis and what we've seen the private equity market, in particular in Europe, having done during the crisis. What I want to do is give you a quick sort of overview, just to remind everybody what we do at KKR, talk a little bit about the setting in Europe of how COVID has affected the economy and what our economists see, and then go a little bit more specifically into what has the private equity market done. So with that, let me kick it off. Just as a reminder, as Naji was saying, we're a global firm. With the recent acquisition of GA, we now have over 270 billion of assets under management. And we cover a lot of different strategies, including private equity, but also infrastructure, real estate, credit, and energy. So a lot of different strategies, all in the alternative space. And we do this on a global basis. We have a big effort in Asia. Obviously, we come from the United States, and we have a big effort in Europe. Within Europe, we're basically active in these asset classes. We have a private equity business, which is our biggest business. We have a sort of core, what we call core private equity business, which invests in longer term, less risky investments. We're in growth equity, so mainly focused on technology. And then we also focused on healthcare. We have two separate funds that focus on these areas in the market. We have an impact business, which is concerned with investing in companies with positive ESG criteria. We have a very large infrastructure effort. We have a real estate business. And then on the credit side, we really have three different buckets. One, which I would call is more of a liquid credit business, leverage credit business. We have a private credit business, which invests in asset-based lending, some what we used to call mezzanine lending. And then we have a special situations business, which invests in sort of distressed capital solutions, debt for control. So that's what KKR is doing in Europe. You can see the countries in which we have presence here. And So we're really active in everything KKR does globally. Really, apart from energy, we're not doing any energy investing in Europe. That we only do in the United States. So that's as much as you're going to hear from me on the KKR advertising. With that, let me talk a little bit about what we've seen in terms of the COVID crisis in Europe. This is quite a busy slide, and what I've tried to do is sort of effectively look at three different parts, which is we had obviously a health crisis, and we still have a health crisis, which currently, for example, affects us. I'm happy to be in our office in Paris. That's open. Our London office has much more restricted access. And obviously right now we cannot freely travel between London and Paris because there's a quarantine restriction if you come into London. So this is the effect of the health crisis that affects us personally, and where we also need to make sure that if I look at my employees, that if they're coming back in a safe manner. So that will continue to affect what happens on the economic basis, which is we've seen significant layoffs in a lot of sectors. If you think about the logical ones, obviously restaurants, tourism sector, these are all, if you want, consumer-facing sectors that have had a significant impact. Right now, we have seen the government furlough schemes where people get paid whilst they're temporarily laid off, cushion a lot of this impact. It is our view, though, that a lot of those people that are temporarily laid off will not be temporarily laid off. They will actually come and stay unemployed. And once the payments that the government has been making start reducing, we will see more of a problem. So that's the sort of economic perspective. Against that, you have to set what government has done. And government has put a huge amount of money into the market. There's been significant quantitative easing. We've had all kinds of schemes to try to stimulate the economy. So right now, we basically have two influences. We have what we're seeing in the real economy, which is potentially significant unemployment. And on the other hand, we've seen significant liquidity inserted in the system. And it's difficult to see right now which of those will win. Clearly, what we're seeing in the stock market is we're seeing a reflection of the significant liquidity that has been injected. But there is in the back of our mind the possibility that the unemployment that could happen will offset some of these positive effects. What we've seen, I've talked about the markets. So obviously, markets have been up significantly. High yield, gapped out, but has come back. So performance has been, over the last 6 months, has been very good in that market. And we were able to benefit from some of that by buying bonds in the 70s and then being able to sell them in the high 90s. And we've seen volatility which spiked, but right now has come back to a much more reasonable level. I want to spend 1 minute on this slide because I think it's very important for Europe. The 750 billion Next Generation EU fund is really a significant change in Europe because it's the first time that we have effectively something where we have European funding which has been mutualized. So all of the European countries are responsible for it. It's a significant step in the direction of fiscal integration. It's something that Germany, Holland, Finland, these countries have always resisted, but this has been implemented. And I think it's a very positive step in Europe issuing debt and Europe having capital to support its economy. Now, what did we do at KKR? So we basically took a view in the middle of April that this crisis was going to be a temporary crisis. And when we looked back at how we behaved in 2007 and 2008, what we've seen there is that we spent all of our time in 2007, 2008 on fixing our portfolio. And we didn't make many new investments. So in the middle of April, the senior management of the firm got together and we said, let's not make this mistake again. Yes, let's have by far the majority of our people make sure that what we have, that our portfolio performs well. We spent a tremendous amount of time monitoring the portfolio, teams that focused on what can we get from the government, how do we make sure that all the latest informations are shared amongst the portfolio companies, etc. But we said, let's use maybe 70% of our horsepower to do that, and let's take 30% to try to invest. And so we've invested significant amounts of capital, as you can see here, almost 30 billion over the firm globally during this period of crisis. And that was on a very deliberate manner. So we really tried to some degree, take advantage of this period in making significant investments. And we've made those in traded credit. That was really something that was very easy to do immediately because these credits were liquid, available, and we could buy. We've made that on the equity markets. We took some stakes in public equities. And then we started looking at where do we have some companies that need liquidity? And then where can we make some acquisitions and find companies that we can buy at attractive values? And we spend time on that. So the majority of this investment has happened in the private markets where we found some opportunities. I've listed a few of these examples at the bottom of this slide. Viridor is a waste recycling business that we invested in the middle in March, basically in the UK, quite a large acquisition that we did. Coty and Wella are two acquisitions that we made in Germany and the US in April. We made an acquisition in a public offer for a company called MásMóvil, which is a mobile business in Spain, which again, we launched in April. We made a public offer for a French media business called Mediamon, which we launched in May. We made another public offer in France for a software business called Devoteam. Again, we launched it in May. Just as an example, we really became proactive, and the conviction there was that whilst we are in a difficult period, this period is going to be limited. And when we have found a vaccine, we will come out of this and we will have been able to buy some assets at attractive prices. So that's our perspective. With that, let me talk a bit about the market. So there is still significant risk in Europe. A lot of my American colleagues like to point that out, but we currently have a lot of European countries restricting foreign direct investment that's aimed at China primarily. There's a lot more control when you want to buy a European business than what we had in the past. What we're seeing is political systems where in Spain we have a minority government with a coalition which has some issues. We have in Germany a political system where the sort of traditional two-party system is no longer existing. We have 2021 elections coming up. We have in Italy, again, a quite unstable situation. So if we look at it from a sort of macro perspective, there are some issues in Europe that we shouldn't forget about. Don't forget what Donald Trump has been trying to do with Europe. He's been trying to lean on Europe by using trade as a tool. That's important for Europe, and there is a risk that Europe gets caught between China and the United States in the trade war that we're currently having. So I think I don't want to make everybody feel like Europe, everything is great. We've made some investment. There's still some potential issues there. Now, I think we're getting paid for some of these issues in terms of returns, but let's not forget about some of the risks. So with that, first of all, the market overall took a very different perspective from the perspective that we took. In other words, most people significantly slowed down their investment during the crisis. And you can see that on the left-hand part of the slide. So a significant reduction, almost a halving in terms of the volume of private equity in Europe during the crisis. We've also seen quite a change in terms of the type of transaction. So there've been way fewer secondary deals. There've been much more sort of corporate carve-outs where companies, and I think it's really driven by the market that we've been in, companies needed cash, and so we were able, as an industry, to buy more from corporates and also families with companies which maybe had their back a little bit more against the wall where we were able to sell. So from an investor in private equity, I think actually quite a good environment because there's a lot more primary deal flow and high quality primary deal flow that we've seen, but overall volumes down significantly.
Johannes, just You mean, so by secondaries, you mean a private equity selling to another private equity?
Yes, Naji, thanks for pointing that out. That's exactly. So it's one private equity firm selling to another private equity firm. Basically, it's what we call a secondary a buyout. And there's much less of that, which I think means the quality is somewhat higher. Again, but what this slide shows is that people have used this period of COVID to spend more time with their portfolio. So we've seen more add-ons for the existing portfolio companies as a percentage of the mix. So significant increase there. And in terms of new deals, obviously the decrease that I just talked about. But I think it's an important point to make. The type of deal has changed. And then, although the carve-out significantly declined, we are continuing to see conglomerates shedding assets. Now, what happened to pricing? Pricing went up, but this is really not due to the fact that people are paying more money, but due to the fact that EBITDA in the companies that were bought have significantly reduced, right? So most of the businesses that we bought on a significant reduced EBITDA. And so when we look at it, we're looking at saying, okay, we cannot take the earnings of 2020 because that's been affected by COVID. Businesses were shut effectively for 3-4 months. And therefore, we basically can't look at those earnings as the earnings that the business will have next year. We sort of see a curve, a V curve, whereby we were running at rate X, COVID hit, earnings come down, and that is what's reflected in this 12.3 times, that we have a much lower base EBITDA. Again, we think that's attractive because we don't think the EBITDA will stay there. We think the EBITDA is going to come back up, and that's quite frankly what we're already seeing in our portfolio. EBITDA is starting to pick back up, so that when we think what multiple did we actually pay over the earnings that this business can sustain, it's a much more attractive multiple. And that's really the way we thought about it. But in terms of the objective numbers, multiples went up basically because people's EBITDA has come down a lot. And we and some of our colleagues were willing to basically take the risk that this EBITDA will come back next year. So that's sort of what we've seen in the market, significant reduction in volume, a sort of change in the type of deals that people have done. So a lot more primary transactions, much less secondary, really explained by the fact that some of the corporates and some of the families had more pressure to sell because of COVID. And on an absolute basis, higher multiples. But I think if you look at that on a look-through basis, which is, these statistics can't do that because you don't know what the projections are of these businesses, these multiples will actually turn out to be quite attractive on a longer-term basis. Of course, we've also gotten much less debt in this market. The banks were more afraid, so the absolute amount of leverage that you've been able to get is less, and that's leverage on a much reduced EBITDA because the banks are looking at the reduced EBITDA. So I think it makes for better capitalized businesses on a low EBITDA, but you're obviously making the bet that EBITDA is coming back as we come out of the crisis. Maybe just 2 words in terms of the fundraising. So clearly fundraising has been affected by the crisis. We've seen much lower volumes being raised and really almost the lowest volume over the last 10 years this year. So we've seen quite a reduction in terms of fundraising volumes, and we've seen a change in mix as to who's raised money, and it's really been a mix that's switched back to buyout. So I would say to more of the traditional larger firms rather than venture capital, growth, fund of funds, secondaries. So I think what we've seen is people have come back to something that's been tried and tested rather than the more riskier areas of where funds have been raised. If we look at performance, what's interesting is, and these are just the vintage years. In other words, this is when the fund was originally raised, and then the return as of today, basically. And you can see that there is a continuing divergence between the top funds and the bottom funds. And that's definitely what we're seeing. We're seeing a sort of bifurcation between people that are doing well and people that are not doing so well. So, clearly, I'm going to finish with that slide. We hope we count as the people that are doing well. Our last two funds have been first quartile funds, and we've delivered a reasonable track record even in these difficult times. With that, I would maybe hand back to Naji. I think you've got one or 2 points, and then we can start addressing some of the questions.
Sure. Yeah. Thank you. Thank you. Yes, any question you had, questions to ask Johanna. I have one question from your presentation. You showed the LBO purchase prices. If we can look at that again, and I agree in latest transactions you've done, the PE is higher just because of depressed earnings. But what's interesting is that from 2009 to 2015, we've seen European purchase price multiples haven't that increased much. I mean, we're ranging between 9 to 10 times compared to potentially what we have seen, if I'm not mistaken, in the US, where the valuation have increased over the years. Can you explain and clarify why is this the case in Europe versus the US?
Yeah, so I think we've seen obviously from 9 times to 11 times is a reasonable expansion. So we've seen some expansion multiples, but you're absolutely correct. In the US, the multiple expansion was much bigger. And I think sort of taking a step back, one of the fundamental differences between the US market and the European market is that the US market is much more driven by the public markets. If you look at the sort of number of total companies, the number of companies in Europe that are private is a much, much larger percentage than the number in the US of the companies that are private. So in the US, we are much more driven by the public markets, and the multiples, therefore, are also much more transparent and driven by the public markets. Because so many of these European companies are private, that market is less transparent, less driven by public market comparables, and therefore I think we are seeing much less of a tendency to match what's happening in the public markets, and therefore also somewhat lower multiples, combined with the fact that the European transactions tend to be more complex. By definition, most of our transactions are multi-jurisdictional, very often multi-currency, and in the US, it's one big market and therefore simpler and more transparent.
Thank you. Touching on your Europe as a multicultural place, when you look at your companies during COVID, have you seen any results that are differentiated between countries, or have you seen results of companies that are similar between sectors?
Yeah, it's definitely sector driven, this. Because, look, very simple. We have a business that's in the travel sector, and that sector has basically there's been no business. People haven't been able to travel. So that company has been significantly affected by the COVID virus. We own a business in Germany that is a company that basically does tax audit, tax returns. So it helps small business to prepare their tax return. COVID, and they help them with some small financial advice. So COVID, of course, has increased some of the complexity as people have been trying to apply for the government schemes. This business, we're 20% ahead of budget, right? So it really depends on the sector as to how these companies have performed. And then by sector, it's very similar across all the countries. It is really sector driven, and certain sectors are just much more adversely affected than others, and some sectors have actually benefited. So, and in our portfolio, we see everything across that portfolio. Maybe I can just spend 1 minute on portfolio performance. The performance of the company, when we were in March, we ran all kinds of scenarios from, base case, worst case, absolute worst case. And what we've seen is that the companies have actually performed better than our base case that we lined out in March. Now, we're probably, compared to last year in terms of EBITDA across our whole portfolio, are going to be down somewhere between 5 and 10%, which is not great, but it's clearly significantly better than what we had feared. So I would say the performance has been, in retrospect, quite solid. We're down, so that's not great, but really not anywhere close as bad as we had feared when the crisis first hit.
And what would you attribute this to?
Well, I think the economy, the fact that these governments have made such big efforts in terms of injecting capital into the economy has given consumers confidence, and therefore we've seen, some of these businesses come back much quicker than we had thought. It's been much more of a V, quite frankly, than a U or an L or all the other letters that we were thinking about as how this market could behave. It's really come back much faster, and I think it's due to the proactive and fast reaction by the governments in providing capital and giving people confidence.
We have a question that I see here. How the pandemic influence your investment themes that you will be pursuing in the future in Europe?
Yeah, it's a super question. So we created a whole team to look at exactly that and saying, look, what is changing? What is permanently changing? What are some of the sectors that we should look at investing behind? And so clearly, part of the reason we've invested in a telecoms business is that we believe there will be more of what we're doing right now, right? There will be more communicating via Zoom. There will be more, even if you can go back and travel, this is not going away. And so we think capacity and the telco businesses that we've seen have performed really quite well. We think that's going to continue. So that's just one theme that we've invested behind. And like that, we've tried to identify other themes as a result of this crisis. Obviously, healthcare is for us a big sector where we're trying to invest behind. We've just bought the largest clinic chain in France. Those are businesses that we think are to some degree benefiting from what we're seeing as a crisis. And there will be, I think, there's going to be a number of these themes which will continue to be relevant even next year or the year after, when we might be out of this crisis, because there is a change in people's behavior.
One of the themes that KKR has been playing over the years has been called consumer experience, and it goes around the consumer spending more on experience than on staples. Has this theme being revisited in your within your team that you're thinking about going forward, as if you want to reduce that consumer experience versus the stable, and the consumer we're going to see buying more essentials and less discretionary items? How do you reflect on that consumer behavior?
Oh, it's a very good question. So, we part of consumer experiences, we own the largest amusement park in Spain, near Barcelona. And obviously, first of all, the park was shut down. Then we opened very late, and we've probably operated at around 20% of capacity. So you can see that people are afraid to go and visit and take advantage of those experiences. And so that's something that we have to take into account. On the other hand, with Upfield, we bought a company that sells margarine, so definitely a consumer staple, and that business has done very well through the crisis. Right, so I think you're right. There's probably going to be more of a focus on we made the investment in Wella, which is a hair care business, again, where you can buy coloring. I don't really need it, but where you can buy something to color your hair. But and a lot of women bought this product because it's for home use. So where you can color your hair without going to the hairdresser. And so those things have definitely increased in use. And again, for those categories, we believe that that's something that's going to certainly continue for some time. It's that we won't see an immediate snapback we think we will see a continued increased home use of some of these products. So yes, I think it's a shift a little bit more to the staple side.
There's one more question here. What do you see? I mean, you cover and you talk to many CEOs of your underlying companies, and what is on top of mind of European CEOs today?
So I mean, it's shifted. I would say, first of all, in March, April, May, everybody was just focused on it was disaster response. Let's make sure the business stays alive. Let's fix it. All ends to the boat, and very much focused on the near term. Right now, I think people are asking exactly the question that you asked me 2 questions ago, which is, what is going to be the long-term effect of what we've just seen? This will have a significant change, societal change, and what is that effect, and what is that effect going to be on my business? And I think people are very much focused on that, and a lot of the CEOs are asking themselves that, longer term, what does this change mean for me and for my business? That's really right now where I see the focus. Most people have seen the business coming back, so it's in a much better shape than it's been, but it's not, it's still obviously not where it was before COVID. And now they're trying to find answers in terms of how can they grow, what do they see as to how the business is going to do going forward.
Great.
Hani, I see a question on tourism. And by the way, I excuse myself for the noise in the background, but we don't have super luxurious offices, and I'm sitting above a construction site. So hopefully this will go away, because it's France and it's almost 6 o'clock and they'll stop working. But I think there was a question on the tourism sector.
Yes, please.
And how has that been affected? I think the tourism sector is probably one of the hardest hit sectors that we've seen. We own some hotels in France and in the Balearic Islands. They're all still closed. We opened some of these hotels in Spain at one point, but then when the UK put quarantine on travel from Spain, we really had to close those hotels. The UK, which provides a lot of the travelers to France and Spain, basically people haven't traveled because of the quarantine issues. So that sector has been significantly affected, and we've basically seen a consistent push out as to when it's going to come back. We thought it will come back in September, and now maybe it's December, now it's next year. So it really is, I think it's one of the most most significant affected sectors. Aviation, of course, as well, goes hand in hand with tourism. So these sectors have been really, really badly affected, and I think it will take them some time to come back.
There's a question on European PE performance versus US PE post-COVID. I think also maybe what we have seen in European PE performance relative to public market, and you showed that median return. Investors who invested in European private equity have maybe outperformed on average 7% the European public equity over the years, no matter which vintage, which is also a larger outperformance, for example, compared to a US investor who invested in US private equity compared to US public equity. The question is, how do you see that going forward post-COVID between European private equity and US private equity?
Yeah, first of all, I think it's too early to tell the difference right now. We don't see. What we've seen is that the US market, was much slower. So we have seen, if you look at this volume trend, it was even worse in the US in terms of volume reduction. And it's remained that way while Europe has already come back a little bit. US really still hasn't come back. So in terms of new deals, there's been a slowdown. In terms of performance of the companies, I would say there hasn't, when we look at our US portfolio, Europe portfolio, Asia portfolio, we haven't seen such a huge difference. I would say Asia has definitely been the least affected because we've seen China and some of these countries come back much quicker. But between Europe and the US, maybe Europe, maybe the US is a little bit behind Europe, but I think it's too early to say that I could make a sort of confident prediction on the basis of that. I do, however, think this return differential will remain because I just think it's structural, and it has more to do with the number of public versus private companies than just the than just how are the companies doing today. So I think that there is a structural difference which explains some of that return differential.
Your pace of investment this year, how does it compare to previous years and same time last year? Another question from the audience.
Yeah, we've invested significantly more. It's probably double what we did last year in that same period.
When you think about your performance, what would you say are the repeatable process that you've put in place that to deliver on this performance consistently? And shed some light on, you've been in the market for many, many years in Europe. So some of the best practices that you've seen investing as an investor in European private equity and private companies.
Well, look, I think it's constantly evolving. Every year we learn more. We try to improve what we're doing. Obviously, I think the focus that we and a lot of our competitors have right now is how do we work with the portfolio to improve the portfolio companies while we own them. And we really believe that that's where we make a difference in creating returns. So we've got big teams of people that are focused on operations. We have a sort of centralized effort that's based on the West Coast in the US that focus on digitalization. And they have people of that team in Europe and in Asia that basically look at what's a digital threat to the businesses that we own, how can we make them face those threats better, how can we get them a leg up. So quite a lot of effort goes into that. We have, specialists in purchasing, specialists in customer relationship management that work with our portfolio companies to try to improve their performance and therefore make them better businesses, and in the end create more returns for us when we sell them. So all the effort really goes into that. We clearly try to improve how we select businesses, but I would say that's fine-tuning. We have good investors. We've always had good investors. We are using new tools as to how we evaluate companies. We're scrapping websites. We're using large-scale satellite imaging to look at how people flows. We're trying to pull on other newer data sources to basically evaluate companies better. But the judgment, I think, is still experience, and we have a large group of experienced investors. But really a lot of effort has gone into this. How do we work with our portfolio companies when we own them, and how do we make sure that we create value while we own these businesses? So that's been where the main focus has been, and I think that's not just for KKR. It's really for a lot of our competitors as well.
Johannes, I'm sure you have had some difficult deals and over your lifetime, and nothing goes up. And what has been some of the lessons learned that you can talk about and share with us on investing in European companies?
Yeah, I mean, so there's there's some mistakes where we basically bought businesses that were in sectors where effectively government regulations started to affect us adversely. And so for sure, I now have a huge aversion to invest in anything where the government could influence you in a significant way. So regulated businesses are something that we're nervous about, because from one day to the next, the government can really change your business model. That's I think is one takeaway. The other takeaway is I think sometimes we've just been we've been too lenient with underperforming management teams. So we've let's give the guy another chance. Let's wait and see how he's doing. Instead of when we really knew in our heart of hearts that we need to change it, it's taken us a long time sometimes to make those changes. And then when you make those changes, you always know that you should have made the change maybe 12 to 24 months earlier. So I think being a little bit more consequent when being confronted with poor performance is something that we've definitely learned, and that's something that we've tried to institutionalize by having a sort of committee of experienced managers that every one of our portfolio companies will come to at least twice a year, and they see those managements. And if the management team isn't good, we're now becoming much more consequent in making changes. So these are maybe two different perspectives of learnings from some of the mistakes in the past.
Great, thank you. Speaking about growth investments, recently you've been also pursuing some growth investments. When we look at valuation dispersion between value and growth, it is at a historical high. Are you going to change your approach pursuing those sectors or slowing down these growth investments that you are pursuing to go into more the value play?
So I would say the two answers. First of all, we have a separate fund. We have a separate fund which is just focused on these growth investments, which is a tech-focused fund. It's focused on the growth investments. Most of the people that are running the fund are maybe half my age. So I'm more probably of a value investor, but they've made some super successful investments, which quite frankly have had very good outcomes. So can I predict if there is a bubble or if this bubble will break? Quite frankly, I don't know. I think technology clearly has a sort of secular wind behind it. I think there is right now so much liquidity in the market that it's hard for me to see what's going to stop this. So I think our growth fund will definitely continue to do this in that fund, but people know the risks that they're taking when they invest in that fund. In our private equity fund, we're switching much more to value investing from growth investing. That's for sure.
We're getting a lot of questions, so I'm going to try to address them all. One question on the EU has agreed to pursue a green recovery. Do you think that sustainable and green business and investment will be the norm? Have you seen demand rise in this space?
Yeah, so I think absolutely the Green Deal, as they call it, is a big deal. And the EU this isn't going to go away. This is something that Ursula von der Leyen has set as one of her core pillars of her agenda for the next 5 years. So we know for sure we'll have this for 5 years. And they're going to change legislation, they're going to change regulation to drive this. So we've got a working group across our impact fund, across our PE fund, to really evaluate this, what impact is this going to have on our portfolio, and what businesses can we invest behind to take advantage of how this is going to change. But I think that will be a significant driver of what we're going to do in the future. It's sort of getting swamped a little bit by everything that's happening with COVID, but I think it's going to be a very, very important fact going forward.
And do you see that theme being the main differentiator between Europe and the rest of the world?
Well, if Donald Trump stays president of the United States, I can't see the U.S. having a similar Green Deal. I do think China is trying to move in the same direction. Certainly they say they are. They haven't really proven it yet in terms of what they've done. But I definitely think Europe is going to continue to be the leader in that area.
Not a private equity question, but more on the real estate. I'm sure you have a view on the future of office space and commercial real estate.
Yeah, I think it's a good question. We definitely think that this is so. Our real estate team right now is not investing in offices and is spending much more time in the logistics space, which obviously is benefiting from people ordering more over the internet. And I do think that we will see a permanent change in how people behave. I see it in our own businesses. I don't think everybody will feel that being in the office 5 days a week or 6 days a week is the way to live. I think people will maybe be in the office 3 days a week and 1 or 2 days work from home. And that's going to have some impact on the requirement for office space. We're seeing, when I look at the investment banks in London, as a result of the crisis, they are moving what they've learned is that, there was always the thing, no, you can't move tech teams out of the core office. Well, the tech teams have been working out of the core office perfectly fine, and the businesses have been continuing to work. So these teams will no longer be sitting in Canary Wharf. These teams will be sitting in Krakow or in Budapest or somewhere else. They don't need to sit there because it's much cheaper and you get as good quality people. So I think we are going to see in some of the sort of core cities maybe a little softer market as regards office and commercial.
Great. Johannes, we're at 45 minutes. We promised to keep it 40-45, and I know your German blood says time is of essence, so I have to wrap it up here. I'm sorry we couldn't address all the questions. Before I give you, maybe if you wish, some last remarks, I just want to mention that Hani Abu Ali, who CEO of Petrol Asset Management, he was supposed to host this call. I covered for him. He had to be absent and apologized for not being there, hosting this webinar with you, Johannes. He had to attend some personal matters. Unfortunately, his dad is not feeling well, and we pray for him and his family. With this, Johannes, maybe last remarks on your side, and we try to wrap it up here.
I really just want to thank you. I want to thank Abdul Mohsen for giving me a chance to speak. I think the family office is really a fabulous institution that you all have built. And we at KKR are really delighted to be associated with you. As I said in the beginning, I wish everybody health and stay safe. Thank you very much, really, for listening to me.
Thank you, Johannes. Thank you, everyone, for listening. Bye-bye.